You are welcome to my class today on issue of shares. Issue of shares. In this presentation, I will examine the following: the meaning of issue of shares, types of issues, types of shares, accounting entries, in relation to issue of shares, then accounts required, the various accounts required on issue of shares. I will also solve question as a work example. If you are just coming across my channel for the first time, or if you have not subscribed in the past, please go ahead and click the red subscribe button so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. What do you mean by shares? Shares is the unit of capital. Shares, unit of capital of a limited liability company. Shares is the unit of capital. Shares is the unit of capital of a limited liability company, or you can call it ownership certificate in the limited liability company. Types of shares. Types of shares. We have ordinary shares. Ordinary shares. The holder of this type of shares are entitled to a variable rate of returns. Their rate of returns is not fixed, unlike the preference shares that attract a fixed rate of returns or dividends. So, ordinary shares, I said they are shares that are entitled. I said the holders are entitled to a variable rate of returns. That is the totality of profit after loan providers and preference shares holders have been paid. The remaining profits, everything goes to ordinary shareholders. Their returns are not fixed. So, for preference shares, this one, they are entitled to a fixed rate of returns or a fixed rate of dividends. The holders are entitled to a fixed rate of dividends. That is preference shares. That is why you may see 5% preference shares, 10% preference shares, but in terms of ordinary shares, you just see ordinary shares. There will be no coupon rate attached. So, what do you mean by issue of shares? The word issue of shares means sales of shares. Sales of shares. When a company sells shares in order to raise money for its finances, that is what we mean by issue of shares. We will categorize our issues into two types of issues. We have the private issues and public issue. The private issue is the issue of shares to the existing shareholders. The issue of shares to the existing shareholders is said to be the private issue. So under the private issue, you may have the bonus issue. Bonus issue. You may also have right issue. Bonus issue can also be called capitalization issue or scrip issue, when the company capitalizes part of its reserves as an additional shares. That is bonus issue. Bonus issue does not involve cash. It's not an issue of shares for cash. but right issue is also an issue of shares to the existing shareholders, but at the price below the market value of the shares. The issue of shares to the existing shareholders at the price below the market value is said to be the right issue. The difference between the bonus issue and the right issue is that in terms of the bonus issue, no cash is involved. But in the case of the right issue, cash is involved. My focus in this presentation is the public issue. That is the issue of shares to the member of the public. The issue of shares to the member of the public. That is my focus in this presentation. So I will examine the bonus issue and right issue in another separate video. So I've told you that issue of shares to the member of the public, that is public issue. Now, types of public issue. Shares can be issued in two ways. We have shares issued and payable in full on application. Shares issued and payable in full on application. Meaning that the entire proceed of the issue of this type of shares will be made during the application stage. The second one is shares issued by installment. Don't forget, I've told you that the word issue of shares means sales of shares. Meaning that the proceed will be paid instrumentally. The proceed of the issue will be payable instrumentally. That means certain amount will be paid during application. When you have application, another one will be paid on allotment. Another one may be paid on first call. Another one second call or final call. So when you have application, allotment, first call, final call, when you have different amount payable at different stages like that, you know that the shares are issued by installment. Now, the proceed of the yield can be made in three ways. We want to have shares issued at par. Number one, shares issued at par. Shares issued at par is shares issued at its nominal value. When shares are issued at its nominal value, such a share is said to be issued at par. I repeat, shares issued at par is the share issued at its nominal value. Shares issued at its face value is said to be issued at par. The nominal value of the share is its face value. If a share of $1, shares of $1, if it is issued at $1, this type of issue is said to be made at par. This is the nominal value. Nominal value. And the issue price is also $1. Issue price is also $1. Where the nominal value and the issue price of the shares, where they are the same, that type of issue is said to have been made at par. Number two, shares issued at premium. Shares issued at premium. This is when shares are issued above their nominal value. When shares are issued above its nominal value, such shares is said to be issued at premium. Remember, I told you that the nominal value of a share is its face value. If the nominal value of a share nominal value, if it is $1, and the issue price is $1.20, the issue price exceeds the nominal value. The issue price exceeds the nominal value by 20 cents. That 20 cents is said to be the premium. The third one is shares issued. Shares issued at a discount. This is when shares are issued below their nominal value. When shares are issued below their nominal value. So, take for instance, if the nominal value of a share, if it is $1, and the issue price, the share is issued at 98 cents, the nominal value of $1 exceeds the 98 cents by 2 cents. The difference of 2 cents is share discount. So I've told you that shares issued at a discount is when shares are issued below their nominal value. Now, let's try to examine the common terms used in connection with the issue of shares. Definition of terms. Definition of terms. Number one term we are going to examine is prospectus. Prospectus is a document in form of advertisement issued by the public companies, inviting the public to subscribe for their shares. That means prospectus is a medium of advertisement. Medium of advertisement. A medium by which the companies can advertise their shares is said to be the prospectus. It is only the public company that can issue prospectus. Private companies cannot issue prospectus. Now, number two, oversubscription. Oversubscription. This is when more shares are applied for than were offered for sales. If a company offers 1 million shares for sales, and if they receive application for 1.2 million, that means the number of application received, which is 1.2 million, is more than the number of shares offered for sales. And where the number of shares offered for sales, where the number of application received is more than the number of shares offered for sales, that is oversubscription. Number three, we have, so before I consider number three, in the case of oversubscription, excess application money will be refunded to those applicants whose application were not successful. So, meaning that if 1 million shares are allotted, the remaining 200,000 shares that were not allotted, they will refund their money back to them. So that is what I mean by that. Number three, under subscription. Under subscription, this is when the number of shares applied for is less than the number of shares offered for sales. The number of shares applied for is less than the number of shares offered for sales. If the number of shares offered for sales, if it is 1 million, and if the company receive application received they receive 800,000 applications, which is less than 1 million shares they've offered for sales. So this case is said to be an undersubscription. Number 4 term I'm going to look at is allotment. Allotment. Allotment is a process by which shares are distributed among the applicants. The process by which shares are distributed among the applicants, that process is said to be allotment. In the case of oversubscription, they might say those that applied for 100,000 shares, they will be given 90,000 shares. Those that apply for 150,000 shares, they may be given 140,000 shares. So when you now give them, when you allot shares, you distribute shares among the applicants. That process is said to be allotment. So what are the procedures for issue of shares? We want to look at the procedures for issue of shares. Procedures for issue of shares. Procedures for issue of shares. When a company wants to issue their shares, remember I told you that the word issue of shares means sales of shares. That is when a company wants to sell shares to the public in order to raise money. The first thing is they will issue a prospectus. Prospectus, that is to advertise their shares. They will advertise the shares through their prospectus. And after prospectus have been issued by the company, they will now be receiving application from the applicants. They will be receiving application. That means in this case, automatically the applicant will pay money to the company. So, and when they paid money to the company, then bank accounts will be created and application accounts, application and allotment accounts will be created in this process. When a company issues shares, the first thing they advertise the shares. The number 2, they will be receiving application from the applicants. So meaning that when the applicants are applying for shares, they will be paying money into the company through their bank account. That the bank receives the money. So you debit the bank account, then you credit the applicant's account, and the applicant's account is what I called application and allotment account. After this process, the next process is the allotment stage. Allotment stage. At this stage, the shares will be distributed among the applicants. So when shares are distributed among the applicant, then they are, in this case, you are going to create the ordinary share capital account, ordinary share capital account. Then it will also affect the applicant account, which is application and allotment account. And where the shares are issued at a premium, that means you will also need to have a share premium account. Share premium account. So after the shares have been allotted, that is, the shares have been distributed to the applicants. That means you have the ordinary share capital, you have recorded the amount in the ordinary share capital account. Then it is possible where the shares are issued by installment. That means you may have a first call account, or you may have a call account. So if in case you have the first call, so that means first call account will be created. In this case, so you are going to have the first call, and ordinary share when the call is made. And when they receive money on course. So you are going to record it in the bank account as well. So, and the course account when money are received on course. When certain costs are due and these costs have not been paid, where costs are due and not paid, that means you will have costs in arrears. You will have costs in arrears. So where you have the costs in arrears, so the money we have, the amount we have paid, the cost account and the costs in arrears account. Where certain costs are due and not yet paid. Where certain costs are due and not paid, that will be recorded in costs in arrears. Costs in arrears is an asset account. So, and after due notification, if the holders of this cost fails to pay, then that means you are going to have forfeiture of the shares will be forfeited. So in that case, you have forfeiture of shares account. So which will affect the cost and forfeiture of shares. And the forfeited shares may also be reissued. So in this case, you have reissue of forfeited shares. Reissue of forfeited shares. Reissue of forfeited shares. These are the procedures for issue of shares. Accounts required. These are the accounts you will need to open on issue of shares. Number 1, bank account. Number 2, application and allotment account. Number 3, ordinary share capital account or share capital account. Share capital account depend on the type of issue. Share capital account, and you may have your cost account. Cost account. You may also have costs in arrears, where certain costs are due and unpaid. Then you will have costs in arrears. And if costs are paid in advance, you may have costs in advance account. Costs in advance is a liability account. This is a liability account, while this is an asset account. Then you may also have forfeiture of shares account. Forfeiture of shares account. And where shares are issued at a premium, you may also have share premium account. Number 9, you may also have reissue of forfeited shares account. Shares account. These are the accounts you will need to maintain under issue of shares. I therefore want to examine the accounting entries. Remember, the principle in use is the principles of double entry. Accounting entries. Double entry principle states that for every debit entry, there must be a corresponding credit entry, and vice versa. Remember, in line with the principle of double entry, we debit the receiver and credit the giver. Now, number 1, when a company advertises for shares, I told you that they will start receiving application from the applicants. Applicants will be the one that will pay money to the company, and the company will receive the money through their bank account. So, application, money received. That is, when the company receives money on application, The company is receiving the money through the bank account. That means bank is the receiver. In that case, debit bank account, and credit application and allotment account with the amount received. Number 2, in the case of oversubscription, I said that excess application money will be refunded to the applicants whose application were not successful. Excess application money refunded to unsuccessful applicants. Refunds of excess application money to unsuccessful applicants. This will only happen in the case of oversubscription. When a company refunds money to unsuccessful applicants, that means company bank account becomes the giver, because bank will be the one that will pay out the money. So in that case, you credit the bank account, you debit the applicant's account, and the applicant's account is the application and allotment account. Debit application and allotment account, and you credit bank account, because bank is the giver, the funds of money with the amount refunded. So you debit the application and allotment account, and you credit the bank account. Number 3, the next thing will be the allotment of shares. The company will start allotting shares. That is, I've told you that allotment means to distribute shares among the applicants. When a company starts allotting the shares, the share capital account will be created. In that case, you are going to debit, that is, on allotment of shares. That is, the company are now distributing the shares among the applicant. In that case, you debit application and allotment account and allotment account with the par value, that is the amount or the par value, the amount during application plus that of allotment excluding premium, if any, and you credit the share capital account. And if shares are issued at a premium, let me call this A, B, with the premium now, on issue, where shares are issued at a premium, the premium will be transferred to the share premium account. In that case, you debit application and allotment account and you credit share premium account with the premium on the shares. Number 4, certain amount in case of shares issued by installment. I've told you that where shares are issued by installment, certain amount will be received during application, another one will be received on allotment, and another amount will be received on cost. Now, with the amount received on allotment now, with the amount received on allotment, with the amount received on allotment. So when the company receives money on allotment stage, the bank account of the company receives the amount. So bank becomes the receiver. In that case, you debit bank account and you credit You credit application and allotment account. That is with the amount received during the allotment. Number 5. The company will make call when calls are made. When calls are made. The company will debit cost account and credit share capital account. Credit the share capital account with the called up value. The company will debit the cost account and credit share capital account with the called up value. Number 6. Upon the receipt of the called up value, that is when the company receives the money on calls now, the bank account of the company becomes the receiver because the company's bank account will receive the money. So bank is the receiver. So you debit bank account and you credit cost account. Number 7. It is possible some shareholder may fail to pay the call up value with the unpaid cost. With the unpaid cost now, cost account will be created when certain amount is due on cost and not yet paid. So in that case, I've told you that cost in arrears account will be created. I've told you that cost in arrears is an asset. And being an asset account, an asset must have a debit balance. So in that case, debit cost in arrears account and credit cost account. The remaining one, or the remaining aspect of this relates to forfeiture of shares. And I'm going to consider forfeiture of shares in a separate video. Example, ICAN Limited with a registered share capital of 50,000, ordinary shares of 1 naira each, of which 30,000 shares had already been issued and fully paid, decided to offer for public subscription the remaining 20,000 shares at a premium of 20 kobo per share. This was to be paid as follows: 30 kobo per share on application, 40 kobo per share on allotment including premium, 30 kobo per share on first call, 20 kobo per share on final call. Application were received for 20,400 shares. By July 22x, the directors went to allotment, and on that date, application money for 400 shares was returned to unsuccessful applicants. All allotment money was received on the due date. Show the necessary ledger entries in the books of ICAN Limited. So that is the question. So now we want to account for the issue of shares in the books of ICAN Limited. Solution. When shares are received, upon the receipt, the number of shares issued is 20,000. That is decided to offer for public subscription the remaining 20,000 shares at a premium of 20 kobo. These shares were issued at a premium. The par value of the share is 1 naira, and it was issued at a premium of 20 kobo. That means it is issued at 1 naira 20 kobo. If you sum up the proceeds from the issued, you have 30 plus 40, that is 70. 70 plus 30, we have 100. 100 plus 20, that is 120, which is 120 kobo, which is equal to 1 naira 20 kobo. That is the proceed. You were told that the premium of 20 kobo have been included in the allotment money. Ordinarily, allotment money ought to have been 20 kobo, but because the premium of 20 kobo have been included, that makes it up to 40 kobo. Now, this is the case of over-subscription. The number of shares in issued is 20,000 shares, but they receive application for 20,400. That is over-subscription. Since it is an over-subscription, that means the excess application money will be refunded to the unsuccessful applicants. Now let's check. By July 2012, the directors went to allotment, and on that date, application money for 400 shares was returned. You know, the 20,400 exceeded the 20,000 by 400. That 400 is the amount returned. How much was received during application? Amount received on application. Application money received. Application money received. They receive application for 20,400 shares times the par value, the color value on application is 30 kobo. 30 kobo per shares on application. So times 30 kobo. So that will give us 20,400 times 30 kobo. That gives us 6,120. The amount received on application is 6,120. Now, since there is an excess application of 400, that means the amount they have received on application will be returned to those applicants whose application were not successful. So amount refunded, application money refunded, 400 shares will be returned to unsuccessful applicant times the amount received on application, which is 30 kobo. Therefore, the amount that will be refunded to unsuccessful applicant will be 400 times 0.3. That gives us 120. That is 30 kobo times 400 shares. So 120 will be returned to unsuccessful applicant. Then on allotment, amount that will be received, or amount of shares that will be allotted. Allotment now, allotment of shares. You know, during application, 30 kobo was received, and during allotment, 40 kobo was equally received. And this 40 kobo received during allotment include the premium, and the premium on this share is 20 kobo. So we have 30 plus 40 minus 20. So 30 kobo during application plus 40 kobo received during allotment minus the premium, which is 20 kobo. So that gives us 70 minus 20, 50 kobo. On allotment of shares now. So allotment now of shares. That is amount that will be transferred to share capital now. Share capital during allotment will be 50 kobo times the number of shares issued, 20,000. 50 kobo times 20,000, that gives us 10,000. Then amount that will be transferred to share premium during allotment. No, the premium is 20 kobo. 20 kobo times number of shares issued, which is 20,000. So the amount that will be transferred to the share premium will be 4,000. So amount received now, amount that will be received during allotment now, amount received on allotment. Allotment is 40, amount received during allotment is 40 kobo times the number of shares issued. 40 kobo times shares issued, which is 20,000 shares. So that will give us 8,000 naira. So during first call again, 30 kobo will be received. 30 kobo. And on final call, 20 kobo. So first call now. First call, 30 kobo times 20,000 shares issued. That gives us 6,000 naira. Then on final call as well, final call, 20 kobo times 20,000 shares issued. That also gives us 4,000 naira. Now, we can now open the necessary ledgers for the issue of shares. Now, back to the requirement. You have to show the necessary ledger entries in the books of ACCA Limited. Now, let's have ledger entries in the books of ACCA Limited. I've told you that when shares are issued, upon the application for the shares, the applicant will pay money to the company, and the company will receive the money through their bank account. In that case, you debit the bank account and you credit application and allotment account. So we open the bank account. You have the debit side and the credit side. So the sum of 6,120 naira was received on application. So the company is receiving that through their bank account. So you debit the bank account 6,120 and you credit application and allotment account. So we open application and allotment account. So we credit application and allotment with the same amount, which is 6,120. We've debited the bank account and credit application and allotment account. So we put bank as our narration. We credit application and allotment account. We said excess application money for 400 shares was returned to the applicants whose applications were not successful. Upon the refund of excess application money, the company bank account is the one paying out the money. So that shows that the bank is the giver while the applicant will be the receiver. Since bank is the giver, we credit the bank account, we debit the applicant's account, that is, we debit the application and allotment account with 120 naira. So we credit bank because bank is the giver, 120. We put application and allotment account. So we now debit the applicant, that is the application and allotment account. So you put bank as the narration. This is the refunds of excess application money to unsuccessful applicants. Then the next thing, the applicants have applied for shares. Since they have applied for shares, the entity will now allot the shares to the applicant. Remember, I told you that allotment is the process by which shares are distributed to the applicants. When the company distributes shares to the applicant that are put in for applications, so that process is known as allotment. Now, upon the allotment of shares, you are going to debit the application and allotment account, and you credit the ordinary shares account. How much? So, allotment of shares, the amount that will be credited to share capital is 10,000 naira. So you credit share capital account. You can call it share capital or you call it ordinary shares. That is 10,000. That is upon allotment of shares. So you open ordinary share capital account, ordinary share capital account. Since we've debited the application and allotment account, you are going to, with the 10,000, you are going to credit ordinary share capital account. So you put application and allotment as your description. Now the shares have been allotted to the applicants. The shares have been allotted. That is, the shares have been distributed to applicants. That means the shares to the tune of 10,000 have, the amount of 10,000 have been transferred to ordinary share capital account since shares have been allotted to them. Then these shares were issued at a premium. It was issued at a premium, that is above the par value. There is a premium of 4,000. This premium of 4,000 will equally be transferred to the share premium account. So from application and allotment account. So you debit application and allotment account, you have share premium. The amount involved is 4,000. And you credit share premium account. You have share premium account. Share premium account. So we've debited the application and allotment. So we are going to credit share premium account. The amount transferred to share premium is 4,000 naira. So remember, everything must be done in line with the principles of double entry. We should find that for every debit entry, there must be a corresponding credit entry. Now, we've done with transferring of money to share premiums. Then, certain amounts of money was received on allotment. When money is received on allotment, the sum of 8,000 naira was received on allotment. With the amount received on allotment, you are going to debit the bank. The company is receiving money on allotment or upon allotment of shares. So the amount received now, they are going to debit the bank account and credit application and allotment account with the sum of 8,000 naira. So we debit bank account, application and allotment. The amount involved is naira. That is the amount received. Then you credit application and allotment account with the sum receipt 8,000 naira. Having done with the application and allotment, since these shares was issued by installment, so certain amount the company is going to make a call, and the call of 6,000 naira were made. I think the applicants were asked to pay the sum of 6,000 naira on the first call. Upon the first call now, when the applicant pays 6,000, the company is receiving the 6,000. They will debit the bank account when that money is received and credit the first call. So with every bank account, we have first call and the amount received on first call, that is 6,000. And you credit the first call account. You credit the first call account. We have first call account. First call, we have debit side and credit side. So in that case, you credit the first call, bank. The amount received is 6,000 naira. Then you now transfer the call of value of the first call to share capital account. That is when that call is made. So with the amount transferred to share capital account, you debit the first call account. With the amount involved, which is 6,000, and you credit the ordinary share capital account. We have first call of 6,000. Then upon making the final call, when you make the final call, the sum of 4,000 naira will be received. In that case, you are going to debit the bank account, because the bank is receiving the money. The company is receiving the money through their bank account. You debit the company's bank account and you credit the final cost account. So we have final cost of 4,000. You now credit the final call account. So with the amount involved, which is 4,000, you also transfer the call of value to share capital. So you debit final call account and you credit ordinary share capital account with the sum of 4,000. Credit ordinary share capital account, final call 4,000. So finally, we balance the ledgers. So the first call and the final calls, they are self-balancing ledger. So you have 4,000. So when you sum up these, your ordinary shares, 10,000 plus 6,000, that is 16,000, plus 4,000, we have 20,000. So balance carried down, that is 20,000. 20,000. So balance brought down. What you have as carried down here, you brought it down to the next period. So you have 20,000. That is ordinary share capital account. So then the bank account, let's balance it. The amount we have in the bank account, 6,120 plus 8,000 plus 6,000 plus 4,000. We have 24,120. 24,120. So balance carry it down now. By the time you subtract 120, you'll be left with 24,000. 24,000. The total is 24,120. Your balance carried down here will be brought down to the next period. Balance brought down 24,000. Then you equally balance your application and allotment account. If you sum up the credit side, you have 14,120. Then 120 plus 10,000 plus 4,000, that will also be 14,120. So these are the necessary legal entries in the books of ACCA. In case you want to have a statement of financial position extract, you can as well have ICAN Limited, ICAN Limited statement of financial position as at whatever period you have. So you start with assets, non-current assets, we don't have any non-current assets. Then we have current assets. The only current asset we have is bank. The balance in bank account is 24,000. 24,000. That means the total asset will be 24,000. That is our total assets. After total assets, the next thing or the next section will be equity and liabilities. Equity and liabilities. Let's have equity and liabilities. As part of our equity, we have ordinary share capital. The balance is 20,000. Ordinary share capital, balance of 20,000. Ordinary share capital of 20,000. Then we also have share premium of 4,000. Share premium of 4,000. So the total equity is 24,000. After total equity, you have non-current liabilities and current liabilities. We don't have any liabilities. So since there is no liabilities, so that means total equity and liabilities is 24,000. The 24,000 you have in total equity and liability also agree with the total assets of 24,000. That is all about the question. This is the part 1. In part 2, I will examine forfeiture of shares and reissue of forfeited shares. So thanks for watching. ZICA.